Welcome back. Now let's take a look at how the markets have performed. It certainly has been an interesting one. Last week was certainly a bad week across most markets, as we saw perhaps some nervousness return to trading then. More COVID-19 cases, perhaps a second wave of the COVID-19 pandemic coming to the fore. And that certainly seems to be the case again then. Earlier today, we saw Asian markets begin to go into some negative territory as well, unfortunately. And that is how things ended. More than 3.5% loss then for the Nikkei index there by close of trade, with the Hang Seng sitting 2.16% down as well then by the end of the day too. When one takes a look at how things have fared then with regards to Europe as well, then that market has gone into negativity as well this afternoon. More than 1% lost across the main three boards there. That's in Germany, France, as well as in London. On the local front, big fall there, 2.71%. We're back below 53,000 points, unfortunately. In fact, we had 52,184 points. So big falls on that front. One would have hoped that the commodities perhaps get some sort of joy at this time, but it's not to be. The gold index is down nearly 6%, a big fall there, with resources overall 3.7% down at this lunchtime trade. Financials going down nearly 2%. Onto the commodities board then. Oil price falling off again. The coronavirus cases increasing out in China. And of course, then in the United States, where you may see even a second wave, has brought more fear perhaps to investors, as they perhaps see that demand may not necessarily spike or rise as quickly as one would have thought. And that has meant that the oil price has dipped again, now $38.04 a barrel. Platinum has gone up around 0.25%, while 1% down, unfortunately, for the gold price, $1,711 a fine ounce there. Onto the local currency, more weakness. It was good while it lasted, unfortunately, but it's not to be. Back above 17 is the South African currency at 17.20 against the US dollar. It's 19.36 then for a euro and 21.54 against the British pound. Let's unpack this just a little bit more. We are joined here in studio by Gary Boyson, who joins us to unpack this a little bit more. Gary, thank you so much for the time. Appreciate it. It's been nervous trading by the seams of things for at least a week now.
No, certainly. I think if you look at where markets have recovered to from the original depths in early March, the markets have been incredibly robust. And what we've seen over the last week is just a renewal of that fear that potentially, markets are pricing in too far ahead. They say Wall Street looks a long way forward. And I think, looking at some of the economic numbers that come out, I think reality is just starting to bite home, especially with what we're seeing in China this morning. Obviously, cases flaring up that's coronavirus cases flaring up in Beijing. It's just reminded people that there is a very deadly virus out there, and this is going to impact the ability of companies to earn and the ability for companies to operate properly.
Yeah. What does that mean, though, for, equities just in general overall? So do we get to a point where we're falling back to the depths we were at, or do we now perhaps just the W that we expect for the economy perhaps coming to the markets earlier than one would have presumed?
No, it's a very good question. It's very difficult to answer because what we're seeing at the moment is that the likes of the NASDAQ back at all-time highs. You're seeing markets that have essentially totally discounted and are looking so far in the future. They're seeing a world in which we're through coronavirus. Businesses have rebounded and the world is back to normal, and that is pricing in a lot. And that is a very aggressive view for the gun. You might say jumping the gun. Now how the actual recovery takes place is financially the stock market will lead the underlying economy. So what the stock market is telling us is that we're going to have a V-shaped recovery in economic numbers, and that is to an extent playing out in the likes of the US labor market. The problem is if we do have a large-scale flare-up of the coronavirus, now what could that potentially mean? And that's, as you are referring to, we might start seeing that W. Many people talking about U's and L's and K-shaped recoveries, but overall it's very difficult to tell whether this is going to be plumbing the depths of where we did see it. The one thing that we can say for almost certain is that in the short term, corporate profits are going to be impacted, and share prices must be brought back to those corporate earnings. So we had Discovery releasing a trading statement today. They're withholding their dividend. They're looking at normalized earnings down between, I think it was 18 and 28%. So that is going to be significant. Companies are going to take pain here. Small more businesses are closing down. It's if we look at it in the context of Discovery, people are going to not be able to pay their Discovery premiums. They're going to see I suppose a drawdown on clients. They're going to have to pay out hospital bills. Like, this is going to affect companies, and markets at the moment are just looking straight through this and saying one day Discovery will be a great company, and that is a very aggressive stance. So my feeling is that you will probably see a sell-off. Most of the if you look at institutional money managers, they're saying that these markets are insane. They're too high given the real situation on the ground, and when everyone starts to believe that, you generally do see stock markets coming back.
Here's one that is definitely insane then. Car rental company Hertz is effectively going bankrupt, but it seems that the share price is something people are willing to try and get into at any price for now. What is the aim here? What is actually happening?
This is a fascinating story. I've been following it. If you look at what happened, Hertz essentially declared a Chapter 11 bankruptcy, which is kind of like in South Africa going into business rescue. So this is not a South African company, it's an international company. But what's happened is essentially, even though the company is essentially in business rescue, people are buying their shares, and they're buying them so aggressively. It's moved from sort of 77 cents, where major investors were exiting the company, all the way back up to $5 a share for essentially a bankrupt company. And now they're pricing this company as $1 billion company, even though the company is essentially bankrupt. Now, the interesting turn of events is that the company has said, well, if you guys are willing to buy our shares at $5, we'll use our share price to raise capital. So what Hertz now has made an application to the courts to say, we're going to essentially use our shares. We're going to issue more shares. We're a company. We can create as many shares as we want. If people are willing to pay $5 for them, that's great. We'll issue all these new shares. We'll sell it to these mystery people who are willing to buy at $5, and we'll raise enough capital to get us out of trouble. And that has now been approved in the courts, and it looks like Hertz is actually going to manage to raise enough capital to get itself out of its bankruptcy eventually.
This is without doing a rights issue, without going into... It's absolutely crazy.
Which is absolutely bizarre. It's got to be one of the first times this has ever happened in market history.
Though? Does this set a precedent?
Which is interesting, because it's interesting to see how this is going to play out, because essentially investors are looking through, they're obviously looking at the Hertz brand, they're looking at what the Hertz could potentially one day do if they had enough capital. A lot of people are arguing that this is based on a platform called Robinhood overseas, which is essentially retail investors in America just going in and buying the market at all costs and saying, we don't really care if this company owes a lot of money, we like Hertz as a brand, we're just going to buy it. And they're essentially gambling on the stock, which is allowing Hertz to do this. But the irony is that these guys might actually end up as right if Hertz can raise enough capital to get itself out of its short-term debt obligations and put itself on a solid enough track that when the car rental businesses pick up again and when people start flying, they can actually make enough money to continue as a going concern. So they might actually get themselves out of trouble just with this very extraordinary way of raising capital.
Sure. We'll mark on that one and really take a look at how things unfold there. Very quickly on another company who unfortunately doesn't have the same luck and has to kind of sell off quite a bit of its entities, Edcon. The difficulty here is that you have a 91-year-old brand here in South Africa for clothing retailers, which is struggling and will continue to struggle even if it is saved at this point in time. And now being put on auction kind of tells you the story.
You look at Edcon. Edcon was in a tough space even before we had the coronavirus. It was already in a place where it was negotiating with its landlords, trying to get basically its cost base down. It was going through a restructuring anyway. It's not a listed company. So it doesn't sit. It's not a company that you can go and buy shares in as a retail investor. But essentially, this was a company in a difficult space that then moved into an even more difficult space with coronavirus. Now you're looking at a situation where you've got incredibly competitive offering in terms of retail space in South Africa. You've got all these foreign entrants, the likes of Zara and H&M, coming in and almost eating Edcon's lunch. At the same time, you've got a consumer that's under enormous pressure. I mean, we're seeing the likes of South African unemployment heading towards the 50% mark at one point. Now, who is going to essentially be able to support Edcon from a customer point of view? It's a competitive space with a customer under pressure. It's a very difficult spot for Edcon to be in. So it's not a huge surprise that we're going to see some of it. And is Edcon going to be the last? I mean, I think we're going to see a lot of our retailers potentially exiting.
Remember Truworths? Wow. how things went there and how it's continuing to struggle on as that TFG brand then as well. Gary, thank you so much for the time. Really appreciate it. Gary Boyson is from Rand Swiss joining us here at the Johannesburg Stock Exchange. Well, that brings an end for the broadcast from